This house in Seattle, Washington is listed at $699,000, and we're going to walk through a real mortgage quote to talk about how much income it would take to qualify for a loan on this house. Because I know that mortgages are super confusing, and you never know how much faith to put in the online calculators and the numbers that they give you. And from there, you never know what that means for you. Are you going to be able to qualify for that? Would those numbers be the same for you? All that is super confusing. So what we're gonna do is walk through a real quote. So hopefully that will give you more reliable numbers than just the numbers that you see on an online calculator. And then it will also give you a sense of why the numbers are what they are, and then what that means for you. So specifically, we're going to walk through two different scenarios. One quote where we are putting 25% down, and then one quote where we are just putting kind of more of a minimum 5% down. And so hopefully, even if that's not you, it'll give you a really good sense of why the numbers are what they are. And if your number is slightly different, it'll help you fill in the blanks there. This is a real mortgage quote. We are a local mortgage broker. My name is Landon Buto. I work with Cleveland Street Mortgage based in Bothell, Washington. So this is a real quote we're pulling on the house. That doesn't mean it's going to be the exact numbers that you're going to end up with. It's not going to be the exact interest rate you'll end up with. It's not an advertisement for those things. So even if those two scenarios aren't exactly what you're coming in with, maybe you're coming with a higher down payment, maybe something in between those two situations, even if it's not your exact situation, these numbers will give you a really good idea of where the numbers should be and how they're going to change if they are going to change in your situation. And then so for each scenario, we'll walk through the whole quote and we'll look at what your monthly payment might be in each scenario. We'll talk about how much cash you would need to bring all in with your down payment plus any closing costs that you're going to have, what to expect on those closing costs. And then we'll finish with how much income is it going to take to qualify for the loan in each scenario. It's going to be different in each scenario, depending on whether you're putting 5% down or 25% down, how much income you're going to need to qualify. But I'll give you a sense of what to expect and how that works at the end there. So let's go ahead and hop into the quote. I'm going to start by walking through the 5% down scenario first, and then I'll come back through the 25% down. Even if you are closer to the 25% down, I'm going to walk through the 5% down and explain things along the way, explain what each component is and give you the information behind it. And then with the 25% down, I'll just kind of zip through and talk through how they changed, but not quite as much information. So let's look at the 5% down. On the right is the 5% down. On the left is the 25% down. And for both of these, I'm assuming a credit score of 740, which is obviously going to impact your mortgage sum. You're probably aware of that. Your credit score is going to impact typically have some impact on your interest rate, and then some impact on your mortgage insurance if you're paying mortgage insurance. Now, your credit score, if you are a first-time home buyer, about a year ago there was a change that meant that if you're a first-time home buyer, your credit score doesn't have quite as much of an impact. It's meant to remove the negative impact of lower credit scores for first-time home buyers. So it won't have quite as much of an impact on your interest rate as it used to, but it still does have a significant impact on your mortgage insurance if you have mortgage insurance. And then the way credit score, the way it specifically impacts your mortgage is typically in 20-point increments. So if you got from 740, anywhere from 740 to 759, it's basically going to be the same pricing block. But then if you get up to 760, anywhere from 760 to 779, that's another pricing block. And then 780 and so on. If you're relatively close to this, then it's not going to be a drastic difference. The further you get from 740, the more difference it's going to make, maybe on your interest rate, and then definitely on your mortgage insurance. So let's go ahead and look at the actual numbers. The 5% down, we're actually seeing a monthly payment of $5,370. So both of these are going to be high because we're looking at a purchase price of $700,000. And I'm kind of assuming most people watching this are they're not going to be coming from they're not going to be selling a house with tons of equity. Maybe you're selling a house, maybe you have a little bit of equity. So not a huge down payment. So 5% down, 25% down, they're both going to be significant monthly payments. So $5,370 for your monthly payment here. And the homeowner's insurance, there's 4 different components of that monthly payment. The first here is that homeowner's insurance, which I'm assuming $150 per month for this estimate. That could obviously vary. It will vary depending on who your insurance provider is and how much you're getting covered. And then it will vary depending on your price point. This particular house, the location is what's driving the price in Seattle there, and it's updated. It's a nice house, but it's not it's a smaller house. It's not going to be a massive homeowner's insurance monthly. So $150 per month is a pretty reasonable estimate for what we see typically in this area for that kind of price point. Taxes of $473 per month. So that is the actual number drawn from the county website for this specific property in 2024. You might see something different on Zillow. Sometimes the numbers on Zillow aren't totally up to date, but if you go to the county website, this is the actual number we're going to get, $473 per month. And both of those are typically, they're going to be included in your monthly payment, even though they're not really part of your mortgage, they're just part of the house. They are factored into your monthly payment for qualifying, and typically they're paid through your mortgage payment. There are exceptions to that, but they're pretty hard to get, they're pretty rare, and not many people are interested in that. But you can look into those if you are curious. Mortgage insurance of $160 per month. Mortgage insurance is something you have to pay if you put less than 20% down. It protects the lender against the possibility of default on your loan. So $160 per month is probably a fairly average number for mortgage insurance. It will vary depending on several things. One is going to be your credit score. Another is going to be just your down payment percentage. If you are someone who is putting 10% down or 15% down, that shows the lender you have a larger down payment, not just the actual amount, but the percentage is larger, and so that shows the lender less risk. And then the loan amount. Obviously, if you are taking a larger loan, it's going to be larger risk for the lender, so the cost to cover that risk is going to be higher. This, if you got to 15% down, in this exact scenario, say you got to 15% down, this would probably drop down to maybe $40 or $50 per month. And then if you got, your credit score up to 760, 780, that's going to drop. But on the other hand, it could go higher, closer to maybe $300. Next component here is principal and interest, which is $4,586, and that is just a function of your loan amount right here, $664,000, and your interest rate of 7.375%. Now again, this isn't an advertisement for that exact interest rate. You're not going to end up with that exact interest rate, but it is a good idea of where we're at for this basic scenario here in the beginning of May. We're in the low to mid sevens typically. Obviously, several factors are going to impact that, but that range of the low to mid sevens is pretty much where we're at right now. So 7.375 monthly payment. This is just showing your principal, interest, and mortgage insurance. So basically, it's not including your taxes and your insurance. It's what is the monthly payment, not including your taxes and your insurance. It's not really relevant except to show, just from the mortgage perspective, from the lending perspective, what your payment is. Points or credit right here. This is the next section. Points are a fee you can pay up front in order to get a lower interest rate. You pay a lump sum up front and you lock in a lower interest rate. Credit is the reverse of that, which is what this is because it's a negative number. Credit is where the lender tells you, I will give you some cash to cover your closing cost if you take a higher interest rate. And so any given day, there are basically interest rates are priced in 8-point increments. So any given day, you're not really going to see any loan without any points or credit. And basically there's to go from 7.375 to the next block down, 7.25, you would then be paying a little bit in points, and so on, all the way down by 8-point increments. You're paying increasing amounts of points, and then on the other hand, going up, you're taking increasing amounts of credit. And the way lenders price their loans, just any given day, they don't really show an interest rate with 0 points. Technically, you could get that with some lenders, not with all. You can get a 0 point interest rate, a truly exact rate where it's 0 points. But just as far as getting a quote, you're typically going to see some amount of points. But for context, this is basically 0. This is as close to 0 as we're going to get, because it's going to take several $1,000s to impact this interest rate at this loan amount for it to be worth it to either you or the lender, either direction, to have an impact on the interest rate. At a loan amount of $664,000, it would take lots of points. So we're talking, $5,000, $10,000 to see that go down a quarter point, maybe to 7.25 or 7.15, something like that. So next section is the lock period, 30 days. That just means when you go to get a loan, you have to lock your interest rate at a certain point, and you can pay for different lock periods. You can pay for 30, 45, 60, sometimes 90, and typically 30 is all you need. 30 is what will make the most sense in most situations, but that's just showing a 30-day lock period. No prepayment penalty means if you paid your loan off early, there's no penalty. Lender fees of $1,195. You're going to get lender fees wherever you go. That just is that's one way they cover their costs outside of the interest rate. They pay their that's one way you pay their services, and you're pretty much going to get those anywhere you go. So just keep an eye out for the whole picture, and make sure that this number doesn't get too high. Keep an eye on what's going on there, and just factor it into your overall pricing. Other closing costs. So besides your down payment, you have to pay cash up front for closing costs when you get a mortgage. And closing costs is generally made of two different components. One of those components is you're just paying all the people who help you get the loan, who help you get the house, paying all the services, all the fees involved in that process. So your appraisal, your inspection, your escrow and your title company, your loan officer, and all those fees and services involved in helping you get the house. The other component is what's called prepaids, and prepaids are just components that you're going to be paying on a regular basis on your monthly payment. But in a sense, you won't be able to start making that payment until a while after you actually get into the house. Typically, you skip your first month of your mortgage payment, and so you just have to pay some of those costs ahead of time. So prepaid interest, some of your taxes, you put those into escrow ahead of time through closing costs. So those are the two components, and what we ended up with here was $14,000. That is on the higher side, but it's just going to depends on several things, but the biggest impact here, the factor that's having the most impact here, is your purchase price and your loan amount. The larger your loan amount, the larger your purchase price, the more your closing costs are going to be. Typically, in this price point, you could probably expect maybe $12,000 to $15,000 in this price point in this area of closing costs. So just keep an eye out and plan on that. So what that means is your closing costs plus your down payment is going to end up in a total cash to close. All the cash you're going to have to bring to escrow in order to close the deal is $50,000. And then let's zip through the 25% down scenario and see how the numbers change now that we're at 25% down. So the monthly payment is now $4,244, over $1,000 less. And obviously, one main reason for that is going to be because you're paying less principal. It's a smaller loan amount, and you're paying interest on a smaller loan amount. So that's going to be a major impact. However, you're also no longer paying mortgage insurance. You can see since we hit 20% down, there's only 3 components over here, so no mortgage insurance. So that's $160 a month right away. And then homeowners insurance and taxes are still the same because those are dependent on the house, not the loan structure. And then principal and interest is now $3,621 instead of the $4,600 over here. Loan amount of $524,000 now. Interest rate is still the same, 7.375. And sometimes you'll see a bump in your interest rate, an improvement in your interest rate if you get from 5% down to 25% down. However, that is not always the case, especially now where lenders are trying to incentivize first-time home buyers, and there are regulations around that to incentivize first-time home buyers with smaller down payments. So that's not always going to be the case, and in this case it wasn't. There wasn't much of a bump there. Monthly payment, again, this is just, now it's just your principal and interest, no mortgage insurance. So it's just your monthly payment, not including your taxes and your insurance. Points of credit now, it's $152 in credit to take the 7.375. And then 30-day lock period, no prepayment penalty, lender fees of the same, $1,195. And now the closing costs are slightly lower because we have a lower loan amount. So you have lower prepaid interest and lower fees that are based on the loan amount. So $13,421 of closing costs, and that $13,400 plus your down payment means you're going to have to bring $190,000 to the closing table in order to get this house. Now, how much income would it take to qualify for the loan in each scenario? How much income would you have to show to the lender in order to get approval for the loan? Now, the income that's required is based on the monthly payment, so it's going to be different in each scenario. The calculation that lenders use to figure out to figure out how much you can qualify for is what's called your debt to income ratio, your DTI. And your DTI is your total monthly debts divided by your gross monthly income. And this is specifically true for conventional loans. It's very similar with FHA, but it's slightly different. And then with a VA, it's pretty significantly different how they figure it out. So they look at this calculation, which is your total monthly debts divided by your gross monthly income. And your total monthly debts is your new housing payment that you're trying to take on, plus any other monthly debts you have. Credit card debt, student loan debt, any other debts you have. They add that all together and then they divide it by your gross monthly income. And they want to see that that number is going to be less than 50%. If it's less than 50%, typically lenders will say, yes, you're approved, you can qualify for the loan. That's how conforming conventional loans work. And that's because there are lenders on the secondary market that buy these loans from the lenders you're actually taking the loan with. And they will typically only buy these loans or buy this loan at this pricing if it meets this standard. So that's what they're looking for. Your DTI needs to be less than 50%. However, just a quick note on this number right here, your gross monthly income. This number is not always what you think it might be. If you are paid in salary, then it's pretty straightforward. It probably is what you think it might be. If you're almost entirely salary, or if you are entirely salary, then they'll pretty much just use the salary for the most part. They still want to see certain aspects of your income that they know they can count on it. But if you have other pay structures, if you're self-employed or if you work on commission, then this number is just not going to be what you think it is. It might be more, but it's probably less than what you think it might be here. So just bear that in mind. There are very rigid rules that aren't super intuitive in terms of how they figure out what to use down here. If you are commission, or if you work variable hours, if your hours aren't guaranteed, because they want to know they can rely on this income, and in order to there are just certain standards, qualifications your income has to meet in order to be usable down here. So the best way to figure that out is just to talk to a loan officer. Feel free to ask questions on that in the comments, but the best way to figure that out is just talk to a loan officer. But let's assume your income is usable. What is the required amount you would then have to be making in order to qualify for these two loans? So basically, we just add this number to whatever other monthly debts that you have, and we multiply it by 2, and that's what you're going to have to be making. At least that. You'll have to be making $1 more than that, then you could qualify for these loans. So I'm going to assume you have no other debts. If you do have other debts, you just add them to this number, but I'm assuming you have no other debts. For this scenario, you'd have to be making $8,488, no comma, per month. You'd have to be making more than $8,488 per month in order to qualify for this loan if you have no other debts. And then in this scenario over here, what is that? $10,740 per month in order to qualify for this loan. Now, again, I'm talking about approval. I'm talking about whether the lender would let you take the loan, would approve you for the loan. I'm not talking about budgeting or whether you can afford the loan. That's up to you. That's up to you and your financial advisor. However you figure that out, you can figure out what you're comfortable with. But in order to qualify for the loan, you'd have to be making at least this much. And then if you came to get the loan, then the lender would approve you for that scenario. So if you're in this price point, if you're making this kind of income and you have something like this cash, hopefully that gives you a sense for, at least right now with interest rates where they're at, for kind of what your budget might be in the area and at least how it works, so that you can start to get a sense of that. If you are interested in getting a quote on a house you're looking at, or if you just want to talk to a lender and see what your income could qualify for, we'd be happy to talk to you. We are based in Bothell, Washington. We do loans in Washington and Idaho, and we love working with new clients. All of our contact information is in the description below, so you can check that out and see what it's like to work with us as well. There's links there to videos and reviews that you can get a picture of what it's like to work with our team, to get a mortgage with us. We'd love to work with you, so please do go ahead and reach out.